Welcome to our High Rock monthly video for September. I am Scott Tomlinson, and with me on the call today is portfolio manager Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we are coming up to our 10-year anniversary. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. Well, August went by quickly. It was the summer of summer. Hopefully you had a chance to watch some of the Olympic events. They were all very exciting. While August was exciting at the Olympics, though, it was pretty uneventful after the rather volatile start to the month, as markets crept back to and slightly positive at the end of the month. Paul, I don't know if you have anything specific to talk about, but August wasn't a huge month other than that volatility at the beginning.
Yeah, that was crazy. I mean, it was a huge one-day sell everything type of day, and then it just rebounded violently, which I think, Scott, we should probably mention two things. Number one, when we see a lot of volatility and huge rallies in the market, it is often indicative of a bear market. Some of the most violent rallies in the stock markets come during bear markets. So, and the second thing to mention is we saw the same thing in the first day of trading in September, which I know this is an August call, but September is starting off on a weak foot again. Although we had a big rally yesterday, being the 9th of September, it's weak again today. So we are in for a period of volatility, and perhaps we can talk later on about how our portfolios are structured to handle that.
Absolutely. And just quickly, we'll go back to how August looked for balanced portfolios. For balanced mandates, we compare our portfolio returns to the Morningstar averages of over 1,000 balanced funds. Most will find that over the most volatile 3 years since 2008, the High Rock performance has been better with the mitigation of the downside in 2022. Certainly, as I wrote my early August blog, for those who happened to have a chance to read it, advisors suggested that investors exit balanced portfolios in 2023 to get to have less volatility and move into things like GICs, where they were getting 5.5 to 6%, but they gave up significant potential and took on a greater income tax burden, because as you can see, year to date, the Morningstar balanced averages somewhere around 9.25, but the 1 year performance trailing back to last August was more than 13.25%. So a lot better than you could have got with a GIC. And of course, you have to take into consideration tax implications, but there's the GIC rates and how they've performed and progressed. But as we can see, with inflation peaking and the Bank of Canada lowering interest rates, GICs peaked in 2023, and their yields are starting to fall.
Yeah, Scott, if I could interject as well, and just on this GIC chart, that was actually a pretty good strategy through 2022, 2023. It has obviously not been a good strategy in 2024 year to date. And there are two reasons why. Number one, it's an enormous amount of reinvestment rate risk. And what I mean, and that is a risk. Anyone out there who's studied different types of risk, that is one. And that being, if you buy a GIC today and it's 6 months or a year or even two, you are foregoing during a rate cut cycle. The next time you go to invest in a GIC, you may have got it at 5% or now 4.5% or something. The next time you go to invest in a GIC a year from now, it could be at 2%. So that's reinvestment rate risk. Whereas if you bought a bond less than even 6 months ago, a 5-year government of Canada yield has rallied about 120 basis points since May. So it's had a huge amount of capital gains. It's been a very effective, it would have been a very effective trade if you bought a 5-year government of Canada bond, which is still considered a short-term bond, and held it to today versus a GIC. You gave up a ton of capital gains and yield.
And a lot of that because you were chasing return as opposed to standing by and letting return work in your favor.
Yeah, and as you mentioned too, the after tax benefit of the capital gains is certainly a lot better. But that is something for people to consider, and if they want to know more about it, they can talk to us. But that is a huge amount of reinvestment rate risk with the Bank of Canada and the U.S. Federal Reserve. We'll find out in the 18th on a rate cut cycle. This is no longer a rate hiking cycle. This is a rate cut cycle, and there's an enormous amount of reinvestment rate risk embedded in it.
Well, we'll get to that in a second. But before we do, Paul, anything that you want to talk about with regards to our special mandates in the high yield or preferred shares?
Yeah, high yield, again, going back to the theme, we'll probably talk more about it in this call, but we've been pretty bullish on owning fixed rate debt and specifically in corporate bonds. So the high yield, they are fixed rate bonds. You're getting a very good premium over obviously government bonds and investment grade. So that's performed well. Not knocking the lights out, but it's really a nice, as we've expressed to those investors, it's going to be what we consider a decent coupon year. It's not going to be, we're not making 20% on the year on this one, but if we can clip out 6, 7, 8%, we'd be thrilled. Now, the downside to high yield, of course, is if the economy is weakening and we do not have a soft landing and we go into a recession, some more levered companies could run into problems. So that's where it becomes a little trickier, which we are monitoring, of course, both on a macro basis and an individual company or micro basis. Preferred shares, similar to our balance mandates, we have gravitated out of a couple of rate resets, which are floating rate preferreds, into fixed rate preferreds. And those specifically two switch trades we've done over the last while have really helped us out. So we continue to look for those type of opportunities, but similar to high yield, it was a fairly static month for us.
Thanks, Paul. And as a reminder, all the work that we do in the short run are intended to help our clients reach their long-term goals, and our asset allocation strategies play that out. But if clients want to discuss that in more detail or talk about adjusting their strategies, we're always available, Paul. So clients should use that opportunity to get in touch with us and talk further. Let's briefly talk about the Bank of Canada because they lowered rates for the third time on September the 4th. And it is expected that they will continue to lower rates. It looks like they're using a 25 basis points per meeting at this stage. The next meeting is on October the 23rd. But as Paul mentioned earlier, we are in a rate reduction cycle, and that we expect to continue probably for quite some time. Well, let's talk a little bit about our global equity strategy. As we have mentioned on numerous occasions, when investors are buying and greed is peaking, prices are high, equity holding allocations become overweight, and we will use that time to rebalance back to under or to at or underweight levels as appropriate for each client's asset allocation strategy. But equally, we look to buy when fear or low levels of greed reach its peak, and we are using the volatility that we've been seeing in early August to spend overweight cash positions, and that worked out nicely for us and for our clients. Now we will watch for the pre-US election volatility for other opportunities. And Paul will talk about this a little bit more, but historically, September and October are potentially more volatile for stock markets. In election years, that increases that potential for volatility. And so we have the U.S. election coming. Uncertainty will create greater fear. Usually that is followed by selling as people try to move away from risky assets into safer assets. It drives prices lower. But this time around, there might be a little bit more uncertainty in the follow-up to the election because there is some concerns about the potential for civil unrest if election results come out and are very close. So that's something we have to be on guard for and definitely be prepared for, correct?
Yeah, agreed for sure. I just thought this was a pretty interesting chart, and just looking at the history, over the last 40 years or so, it certainly seems post-election that the market does a bit better, a fair bit better, in fact. So, having said that, it looks like there's still potentially some downside to go through the month of September and into October. So it's just something to keep our eye on as we try to manage risk through this volatile period.
And we will keep an eye on it for sure. Anything to discuss with regards to the tactical strategies?
Yeah, there were no real trades in there. Everything kind of, well, I'd say on average things performed okay in tactical, but in fact, some of the things were at recent highs that we have in there. But energy has given up some ground, and we do have some energy exposure in the tactical model. So just in the first week of September here, energy has given up a fair bit of ground, and that's starting to hurt some of those positions a little bit. And again, they are modest weights for most of our clients, so we're properly situated. And in fact, if some things really it gets more volatile and we see a lot more weakness, we certainly have room to add to a few positions. That's about it for the tactical model, Scott.
Great, thanks. And anything that you want to talk about in our fixed income model?
Yeah, just quickly, government bonds, as I mentioned earlier, have done extremely well, certainly through the month of August and again since May when the recent peak in yields came off 120 basis points or 1.2%. Investment grade track government bond yields very closely, so they actually added value. High yield bonds, as I mentioned earlier in our high yield mandate, those bonds in our fixed income mandate performed well. And then the other thing I would mention is the preferred share sector in the fixed income model. We still have that performed quite well over the month, but we still have two bank rate reset preferred shares in good size weights that our plan is, or our hope and our investment thesis, that they will be redeemed or called by the issuer. One is Bank of Montreal for late November. They have to call them, they have to make the redemption notice or extension notice no less than 30 days in advance. So that particular preferred, the BMO W, we will hear by October 31st. And then there's one in late January that we will have to hear by December 31st, and that's for a commerce CIBC pref. So those two prefs still have a little bit of juice left in them. Number one, some of that in the capital gains, and the other part of the juice will be in another dividend. So that's we're waiting on those. And once those get redeemed, as we believe they will, that'll release some cash as well. So I would just add in here, like, because interest rates are coming off or lower, we look at that. That's very important risk. Interest rate risk is very, very important to what we are doing here. So we understand how rates going higher or lower affect our overall risk and our performance.
Yeah, and
But
that's the interest rate. That's the interest rate risk that you were commenting upon that you take on when you buy a GIC, because when you have to redeem that GI or when that GIC matures and you have to reinvest, that's interest rate risk, correct?
well, it is interest rate risk for sure, but it's also reinvestment rate risk.
Right.
You know, if you know, you think about it, like if you know the bank's going to cut interest rates, and if we look back at that chart, they've only cut 75 basis points after going up however many, 3 or 4%. Like it's nothing. It's a drop in the bucket. It's in my opinion de minimis, and they're way behind the curve, both the Bank of Canada and the Fed. So if the bank's cutting rates and they have to cut another 200 basis points, that's why would you own short-term interest rate risk? Why would you not own slightly longer, like 3, 5, 7 year rate risk? And especially in a corporate bond, investment grade corporate bond, where you probably don't need to worry about, a telco like a Bell or a Telus or infrastructure um, pipeline companies like Enbridge or TRAP, TransCanada Pipeline, going bust. Like they've got 90% of their revenues out for the next 20 years. So that's the type of risk you should be, investors should be looking at is fixed rate risk. You lock in an investment for 3 or 5 or 7 years or 10 years, because we could see rates go down lower than we think. They went up more than we all thought the past couple of years. They're probably going to go down more than we think and most other people think. But I think we're probably a little more bullish on it, Scott.
Yeah, I think so. But it brings up an interesting point because people who buy GICs aren't necessarily getting quality advice when they're doing that, and I think that's something that um, uh, where we raise the bar at High Rock. All right, thanks, Paul. And just before we finish off here, I have talked a little bit about the athletes that we support. And one of those athletes is a young gentleman by the name of Finn Gilbert. He's starting his under 16 season this year with the North Central Predators out of Aurelia, but he's high on the list of the scouts, and so we're keeping a pretty close eye on him. He's going to have a tournament coming up at the end of September. We're hoping to get to see. So anyway, just wanted to raise everybody's attention to keep an eye out if you can for the name Finn Gilbert as he progresses into the year where he will be up for draft in the junior draft, and then obviously college scouts from the United States are going to be paying attention to him as well.
And then we'll look forward to seeing him on TV when he's an NHL star.
I hope so. Anyway, as always, we want to thank you for taking the time out of your busy schedules to tune in and listen to what we have to say. We'll be back with our next update at the beginning of October. Until then, this is Scott Tomlinson on behalf of my colleagues Paul and Diane. We want to wish you all the best for the month of September.